Hello, and welcome to our webinar on the filing requirements of certain foreign-owned U.S. single-member LLCs having to file Form 5472. As with all of our webinars, we're going to start out with a disclaimer. This presentation was prepared for educational purposes only. This presentation is not legal or tax advice, nor is it to be construed as such. Each individual circumstances are different. You should seek legal and or tax advice to address any specific questions you may have. My name is Jimmy Sexton. I'm going to be your presenter today. A little bit about myself. I have a bachelor's in business administration with an emphasis in finance, a JD, and an LL.M in international taxation. I'm the president of Esquire Group, which is an international tax advisory firm with offices in Austria, Germany, the USA, and the United Arab Emirates. Esquire Group specializes in international taxation, including tax issues facing U.S. citizens and resident aliens living abroad, expatriation, investing or doing business abroad, and or foreign investment in the U.S. And I am fluent in English and German. So diving right into our webinar, in December of 2016, the United States Treasury, together with the Internal Revenue Service, issued final regulations requiring U.S. disregarded entities owned directly or indirectly by foreign persons to file Form 5472 to report reportable transactions, starting with tax year 2017. So this sentence contains a lot of information that needs to be defined and understood in order to understand the Form 5472 filing requirements as it applies to U.S. disregarded entities. We need to explain what a disregarded entity is, what direct and indirect ownership is, as well as what reportable transactions are. So before we dive into what a disregarded entity is, let's just talk very briefly about what direct and indirect ownership are. So direct ownership is pretty simple. If you own a disregarded entity, that's direct ownership. But let's say, for example, let's say you're an Australian and you own this United States disregarded entity through an Australian trust, for example. That would be considered indirect ownership because you don't directly own the U.S. disregarded entity, you own it through another entity. So even if you indirectly own the U.S. LLC, there would still be a 5472 filing requirement potentially based on these new regulations issued by the Treasury and the IRS. So now that we've talked a little bit about what direct and indirect ownership is, let's dive into what a disregarded entity is. And it's fairly simply put, it's exactly what the name implies. It's an entity disregarded as separate from its owner for tax purposes. So basically, it's an entity that for tax purposes does not exist. An example of this is, let's say, for example, you're a foreign person, you own 100% of a U.S. LLC that's a disregarded entity that owns a rental property, let's say. The LLC itself wouldn't file an income tax return. You, as the owner of that LLC, would file an income tax return to report those income and expenses. Hence, the company is disregarded, the disregarded entity is disregarded for tax purposes. In the United States, by far and away the most common disregarded entity is a U.S. single-member limited liability company that accepts its default tax classification. So let's talk a little bit about what the default tax classifications are for U.S. single-member LLCs. So a U.S. LLC that has one owner is a disregarded entity by default. So you don't have to file anything or do anything to make it a disregarded entity. That's its default classification. So if you form a U.S. LLC and you own 100% of it, it's a disregarded entity. Unless you file an entity classification election and elect for that U.S. LLC to be taxed as a United States corporation. The big difference is by electing it to be taxed as a U.S. corporation, then the LLC itself becomes taxable and has to file separate tax returns and so on and so forth. A U.S. LLC with more than one owner by default is a partnership, meaning that it has to file a tax return, but the partnership itself, meaning the LLC, would not be taxable. The tax return simply says how the income and expenses were divvied up amongst the partners. A U.S. LLC with more than one owner can also file an entity classification election to be taxed as a corporation and become taxable as an entity in and of itself. So what we're talking about in this webinar is the single member LLCs, meaning U.S. LLCs with one owner that are disregarded for U.S. tax purposes, meaning that they accepted their default classification and didn't file any type of entity classification election, and that are owned by non-U.S. persons. So U.S. disregarded entities, as I explained before, generally are not required to file U.S. tax returns. The owner of the U.S. disregarded entity would include any income and expenses on their own tax return. U.S. disregarded entities are also generally not required to get an employer identification number, or an EIN, which is the tax ID number for a company in the United States. The disregarded entity would use the tax ID number, so either the EIN or the Social Security number or ITIN of its owner for tax filing purposes. As I just stated, the U.S. owners of the owners of disregarded entities are required to include the disregarded entity's income, expenses, assets, and liability on their U.S. tax returns. That means that the IRS is going to get information about that disregarded entity and its income, its expenses, its assets and liabilities, so on and so forth, when its U.S. owner files its U.S. income tax return. So as an example, let's say you had a U.S. citizen that owned a disregarded LLC that had rental income. That U.S. person would include the income and expenses of that rental property on their individual tax return. Hence, the IRS is getting information about that disregarded entity's income and expenses. Likewise, if you had a United States corporation that owned a disregarded entity LLC, all of that LLC's income and expenses would be included on that U.S. corporation's income tax return, and its assets and liabilities would also be included on that U.S. corporation's tax returns balance sheet. So if a U.S. person owns a U.S. disregarded entity, and when I say U.S. person, I'm talking about individuals, corporations, partnerships, so on and so forth, all of that LLC's income and expenses, as well as assets and liabilities, are going to be included on the U.S. owner's tax return, and the IRS is going to get information about who owns that disregarded entity, what kind of income and expenses it has, assets, so on and so forth. Now, contrary to that, foreign owners of U.S. disregarded entities are only required to file U.S. tax returns if they were engaged in a U.S. trade or business or had certain types of U.S. source income. So if the U.S. disregarded entity was owned by a foreigner and was not engaged in a U.S. trade or business or did not have certain types of U.S. source income, neither the foreign owner or the U.S. LLC itself would have any tax reporting obligations in the U.S. And so for this reason, the IRS has very little insight into the financial activities or ownership structures of foreign-owned U.S. LLCs. A perfect example of this would be, let's say we had an Australian that owned a U.S. LLC, and this U.S. LLC was a disregarded entity, and this disregarded entity had no assets or no income or anything in the United States. Let's say it had a bank account in Panama, for example, and owned rental property in Panama. The U.S. would have absolutely no insight into the fact that this U.S. LLC has income, that it has assets, or who its owner is, because it's not engaged in a U.S. trade or business and it doesn't have any U.S. source income. So there's a big lack of reporting and insight into the ownership, income, expenses, assets, and liabilities of foreign-owned U.S. Disregarded entities, absent a U.S. trade or business or certain types of U.S. income. This is very different to other types of U.S. entities that have foreign owners. For example, foreign corporations and U.S. corporations with a certain level of foreign ownership, and U.S. partnerships with a certain level of foreign ownership have to report the foreign ownership, and they also have to report their income and expenses, and they have to report transaction with related parties. So for other types of entities, the U.S. is getting information regarding those entities' assets, income, owners, so on and so forth. But with disregarded entities, basically single member LLCs, they're not, which is why these new regulations were passed to remedy that situation and try to get some more insight into the ownership and finances of these foreign-owned U.S. disregarded entities. So the example that we're going to talk about here is the reporting requirements related to 25% foreign-owned U.S. corporations. So if there's a U.S. corporation, we're switching gears a little bit right now. We're talking about U.S. corporations and not disregarded entities for a couple minutes here. If you have a U.S. corporation that's 25% owned, 25% or more foreign owned, that U.S. corporation is going to have to file a Form 5472 to report reportable transactions with related parties. So, with foreign owners, with companies under common ownership, things like that. These new regulations treat U.S. disregarded entities as 25% foreign-owned U.S. corporations for purposes of filing Form 5472. So, since in order to be a disregarded entity, there has to be 100% ownership of this U.S. LLC. And so basically all single member LLCs that are taxed as disregarded entities would have 25% or more foreign ownership. And since they're now treated as U.S. corporations for the sole purpose of filing this Form 5472, foreign-owned U.S. disregarded entities, essentially United States LLCs that have accepted their default classification as disregarded entities, will be required to file Form 5472 to report reportable transactions with related parties. They'll also be required to maintain records related to the reportable transactions with their foreign owners and related parties in order to be able to give the IRS that information should they request it. So what is a reportable transaction? What are going to be the triggers that are going to trigger this 5472 filing requirement for foreign-owned U.S. disregarded entities? So basically sales, contributions, assignments, licenses, loans, rights to use property, performance of services, rents, and there's some other ones. But let's take a look at some of these examples because they could be more far-reaching than many people realize. So, for example, sales. So if the U.S. LLC buys anything from a from its foreign owner or foreign related party, that would trigger a 5472. Or vice versa, if the foreign entity, if the foreign owner or related party purchased anything from the LLC. I think one of the other ones that is very important is what happens, for example, if the foreign parent of the U.S. LLC gave the U.S. LLC a loan. That would also trigger 5472 filing requirement. And vice versa, if the U.S. LLC gave the foreign parent a loan, that would also trigger the 5472 filing requirement. And I also think that the rights to use property is a very important reportable transaction to point out, because I think this could impact a lot of people with vacation homes in the United States. So I know that quite a few foreigners have purchased vacation homes in the United States, and for asset protection purposes, they've put those LLCs, they've put those vacation homes in single-member LLCs, which are disregarded entities. Because the foreign owner is using this property owned by the LLC as a vacation home, they have the right to use that property owned by the LLC. That right to use the property would be considered a reportable transaction and would trigger a 5472 filing requirement. So let's assume a 5472 needs to be filed by the U.S. LLC that's a disregarded entity and foreign owned. What's going to have to be provided? So first of all, the owner is going to be identified, and also information regarding the reportable transaction. So the type of transaction: was it a loan? Was it a sale? Was it a right to use property? How much was the transaction for? Things of that nature. The 5472 filing requirement is going to be triggered whether or not the foreign owner is actually required to file a U.S. tax return. So let's go back to the example of owning a foreign-owned U.S. disregarded entity owning real estate in the United States. So let's say, for example, this LLC is owned by a foreigner and it owns a rental property in the United States. In this particular situation, there could be a 5472 filing requirement depending on the transactions between the foreign owner of the U.S. LLC and the U.S. LLC. But that foreign owner is also going to have a tax return filing requirement in the U.S. to report the income and expenses from the rental activity. Now let's switch gears and compare that to a foreign-owned U.S. LLC that's taxed as a disregarded entity that owns a vacation home. In that particular instance, the property isn't generating any income. So the owner of that LLC, that foreign owner of that LLC, is not going to be required to file a U.S. income tax return. But the LLC itself is still going to be required to file a 5472 based on the right to use property to report the foreign owner and certain information about the reportable transactions, even though the foreign owner doesn't have a tax return filing requirement in the United States. So the 5472 filing requirement is separate from any income tax return filing requirement in the United States. In order to file Form 5472, the U.S. disregarded entity is going to be required to get a U.S. employer identification number, an EIN. As stated before, the EIN is a tax ID number for entities, which is what an LLC would be required to get. EIN applications require a responsible party to be identified. The responsible party is essentially defined as the person who has the control, the ultimate control over this entity. And the responsible party is going to have to also disclose their social security number, their individual taxpayer identification number, or EIN in case of an entity, in case of the responsible party is an entity, which really only applies in the case of U.S. disregarded entity, single-member LLCs being owned by publicly traded companies. Otherwise, the responsible party is going to be an individual, and the responsible party is going to have to give their social security number or individual taxpayer identification number. If the responsible party doesn't have a social security number, an individual taxpayer identification number, or an EIN, they're going to have to obtain one before being able to obtain the EIN for the single-member LLC, and then only can they file the 5472. Getting ITINs and EINs can be a burdensome process, so if you know you're going to have a 5472 filing requirement, or better said, the LLC you own is going to have a 5472 filing requirement, it would probably be advisable to start the process of getting your taxpayer identification number. Now, The Form 5472 filing requirement, as stated, is new for 2017. That means that the first 5472s are going to have to be filed in 2018 for tax year 2017. Thank you very much for attending our presentation today. I hope that you found it informative. We'll be posting a recording of this webinar to YouTube in case anybody wants to watch it again. Thank you so much for attending. Goodbye.